Have you tried everything and still found no real solution? If that's the case, the new minutes will be a game changer. Keep on watching.
Real estate with realtor Kashif Sohail. Welcome to Washington America Show with international multimedia journalist, multidimensional, multifaceted artist and director of Human Rights Justice Council USA, Dr. Kashif Sohail.
The primary mortgage market consists of direct lenders, also known as prime lenders or originators, who make mortgage loans directly to borrowers. Some primary lenders retain the mortgages they originate, but most sell their loans to other investors. By selling their loans, they liquidate their investment and receive additional funds to make more loans. Most primary lenders continue to service loans even after they sell them. Servicing a loan includes collecting monthly payments, dispersing funds to pay property taxes and insurance, supervising the loan, and handling delinquencies, early payoffs, and mortgage releases. For this service, they charge a collection fee. Sources of direct loans include savings and loan associations, S&Ls, commercial banks, mortgage bankers, mortgage brokers, and life insurance companies.
There are federal banks and state banks. Federal banks are chartered by the federal government and regulated by the Federal Reserve Board. Commercial banks primarily make loans to assist commerce, especially in the areas of business loans, home improvement, and short-term construction, interim financing. Demand deposits, checking accounts, are the primary source of funds for commercial banks. Due to this focus, commercial banks must be more liquid than S&Ls, and their loan portfolios tend to be dominated by short-term, high-yield loans. Commercial banks do participate in the residential real estate market in a variety of ways. Many are active on the secondary market, selling home loans they originate and buying packages of loans at a discount. Large commercial banks also have bank holding companies and trust departments that are active in the financing and ownership of commercial real estate developments such as shopping centers, large apartment complexes, resort properties, and the like.
Savings and loan associations, S&Ls, promote home ownership and private savings. S&Ls often offer higher interest rates on deposits than commercial banks. All savings and loan associations must be chartered by the federal government or by the state in which they are located. Federally chartered associations are regulated by the Office of the Comptroller of the Currency, OCC, and their accounts are insured through the Federal Deposit Insurance Corporation, FDIC. The FDIC insures depositors up to $250,000 per individual account and per institution. State-chartered associations may, but are not required to, subscribe to the federal insurance program. S&Ls make both conventional loans and loans involving government backing, like the FHA and VA programs. However, the majority of S&L loans are conventional loans made on residential dwellings of 1 to 4 units. Conventional loans are loans that do not involve government programs. In addition to originating mortgages, S&Ls also buy and sell mortgages on the secondary market.
A mortgage banker or mortgage company may be a person, firm, or corporation. They are not banks because they do not take in deposits, however, they do originate and service mortgage loans. While banks and S&Ls use customer deposits for mortgage financing, mortgage bankers usually borrow funds for mortgage financing. Mortgage bankers frequently borrow funds from commercial sources, make loans, and then package and sell mortgages at a discount to investors on the secondary mortgage market. To be profitable, mortgage bankers must lend in sufficient volume and sell immediately. Mortgage bankers close loans in their own name, assume risks, and continue to service loans even after they are sold. This contrasts with mortgage brokers, who are true intermediaries and merely represent investors. Mortgage bankers make commercial real estate loans and are also major originators of FHA and VA loans.
Mortgage brokers are not lenders. They do not service loans in their own name. They are true intermediaries who arrange and close loans in the name of the lender. Borrowers usually contact mortgage brokers directly. The mortgage broker then qualifies the borrower in the real estate project before contacting the lenders. If she is successful in arranging the loan, she will charge the borrower a fee, usually in the form of a percentage of the loan.
Life insurance companies are concerned with risk and long-term stability. These insurance companies are some of the largest groups of investors in the commercial and industrial real estate markets. Accordingly, they invest mostly in large real estate projects and commercial properties such as multi-use office parks, apartment complexes, and shopping malls. Life insurance companies also play a role in the residential real estate market. Traditionally, their involvement in residential mortgage loans has been only as a buyer of large blocks of packaged loans on the secondary market. However, they are increasingly originating residential mortgage loans on the primary market through mortgage brokers.
Whereas primary markets originate loans to eligible buyers, the secondary mortgage market provides liquidity to primary lenders. Investors on the secondary market purchase mortgages for long-term investment. Investors on the secondary market may purchase individual loans, but usually purchase mortgage-backed securities. When mortgage holders package a group of mortgages, they issue securities and each security represents a share in the package. The primary institutions in the secondary mortgage market are Fannie Mae, FNMA, Ginnie Mae, GNMA, and Freddie Mac, FHLMC.
The Federal National Mortgage Association, Fannie Mae, was originally organized as a federal agency that purchased FHA-insured loans. It has since evolved into a government-sponsored private corporation and has become the single largest private mortgage purchaser. Fannie Mae does not loan money directly, but instead generates funds for its secondary mortgage market operations by buying and selling FHA, VA, and conventional mortgages, and by selling securities, mortgage-backed bonds, and discount notes in the money market. Fannie Mae stock was previously traded on the public stock market, but has since been delisted from the New York Stock Exchange. When mortgage funds are in short supply, Fannie Mae buys mortgages. When there is a surplus of funds, Fannie Mae sells mortgages.
The Government National Mortgage Association (GNMA) is a government-sponsored corporation without capital stock which was organized to operate the federal subsidy housing loan programs. During times of financial difficulty, high discount rates imposed by the Fed, and high interest rates, Ginnie Mae and Fannie Mae work together to provide special assistance programs for low-yield, high-risk loans, primarily FHA and VA. This helps to stabilize national real estate financial markets.
The Federal Home Loan Mortgage Corporation (FHLMC) is a government-sponsored private corporation, which operates under the supervision of the Federal Housing Finance Agency (FHFA). Freddie Mac was organized to borrow money from pension and trust funds, to purchase mortgages and pool them together, and to sell bonds on the open market with mortgages as security. However, FHLMC does not guarantee payment of Freddie Mac mortgages. To accomplish its mission, FHLMC purchases conventional mortgages, FHA and VA mortgages, GNMA mortgages, and conventional mortgage-backed securities from S&Ls and banks in the secondary market.
Sometimes the seller, not a third-party lender, finances a real estate transaction. A common method of seller financing is the land contract. A land contract is an installment contract for the sale of real estate. Under a land contract, the seller retains legal title to the property until or unless the buyer completes all installment payments. The buyer receives equitable title while making installment payments. Upon the final installment, the seller transfers legal title to the buyer. This arrangement is also known as a contract for deed.
In addition to conventional loans made by private lenders, there are various government programs available to qualified borrowers. Government programs may insure and guarantee funds borrowed from a private lender. In limited circumstances, government programs can fund loans as well.
The Federal Housing Administration (FHA) operates under the Department of Housing and Urban Development (HUD). It was created during the Depression in 1934 to stabilize a collapsed mortgage and housing market. The FHA does not build homes, lend money, or set interest rates. Instead, the FHA insures long-term loans made to qualified buyers by FHA-approved lenders. By insuring mortgage loans, the FHA enables lenders to make riskier loans, which subsequently enables more people to purchase homes. The FHA only insures loans that meet specific criteria that it sets through various programs. The FHA criteria covers building structure, the method of construction, qualified appraisers, how to determine a borrower's creditworthiness, and minimum standards for lenders. It also sets the maximum loan amounts that it will guarantee for various regions of the country.
FHA and HUD do not set interest rates. However, most FHA programs require that a mortgage insurance premium (MIP) be paid for the life of the loan at closing. This one-time MIP may be paid in cash or may be financed by being added to the loan amount. With an FHA loan, either the buyer, the seller, or a combination of the two may pay the MIP, loan origination fee, and discount points. For loans originated after December 1989, buyers must be completely qualified before assuming a loan.
Primary market lenders qualify borrowers and property according to FHA standards, which are less stringent than conventional loan standards. Then, the lenders enter into various mortgage agreements, fixed-rate mortgage, adjustable-rate mortgage, etc. The borrower pays FHA mortgage insurance for a limited period of time. In the event of a default, the lender makes a claim against the FHA insurance policy for a portion of its loss. This reduces the risk of lending to certain borrowers.
FHA loans permit borrowers to make lower down payments (LTV) than typically permitted by conventional loans. Borrowers can pay as little as 3.5% down or 96.5% LTV. Such low down payments are possible because FHA insurance allows borrowers to finance approximately 97% of the value of their home purchase through their mortgage, in some cases.
FHA borrowers must purchase FHA mortgage insurance. Borrowers pay an upfront mortgage insurance premium at the time of purchase, which may be financed, as well as monthly premiums that are added to the regular mortgage payment. For most homes, an upfront mortgage insurance premium of 1.75% of the loan amount must be paid at closing. This amount may be financed. Thereafter, a monthly insurance premium is due along with the monthly mortgage payment.
Thanks for watching, and don't forget to click the link below in order to find out more.
Please share this video, subscribe to our channel.
Are you looking to buy or sell a home anytime soon? If so, you've come to the right place. We'd like to give you the opportunity to work with one of the top local real estate agents and get the best deal when buying or selling a home. The fact is, experienced agents can often get you a 2 to 10% better deal on the purchase or sale of a property, mostly due to their experience in the local marketplace and their ability to negotiate the best deal. So contact our top agent now and start the process of buying or selling your home.